Welcome back to XRP On Moon, the channel where we break down the biggest, most important XRP developments before the rest of the market fully understands what's happening. Today's topic is something that has quietly been building in the background, but now it's starting to explode into the mainstream narrative, the idea of an XRP ETF. And if you think this is just hype or just another rumor floating around the crypto space, you need to pay very close attention because what we are seeing right now is a shift in how institutional money may soon interact with XRP. This isn't just about price speculation anymore. This is about access, legitimacy, and the potential opening of a completely new capital pipeline into the XRP ecosystem. To understand why this matters so much, you have to look at what happened when ETFs were introduced for other major cryptocurrencies. When Bitcoin spot ETFs were finally approved, the entire market dynamic changed almost overnight. Suddenly, large institutional players who were previously restricted or hesitant had a regulated, familiar way to gain exposure. Pension funds, hedge funds, asset managers, they didn't need to worry about custody, private keys, or navigating crypto exchanges. They could simply buy into an ETF just like they would with any traditional asset. That convenience and regulatory clarity acted as a magnet for capital. And now, the conversation is shifting toward whether XRP could be next in line. What makes this even more interesting is the timing. XRP has spent years under regulatory pressure, particularly due to the legal battle involving U.S. Securities and Exchange Commission and Ripple. That case created uncertainty, not just for retail investors, but for institutions as well. But as clarity has slowly started to emerge, sentiment is changing. The market is no longer viewing XRP as a high-risk legal gamble. Instead, it's beginning to see it as a digital asset with a defined regulatory path. And that shift is absolutely critical if an ETF is going to become a reality. Now, here's where things start to heat up. There have been increasing discussions and signals from financial firms exploring the possibility of XRP-based investment products. While nothing has been officially approved yet, the mere fact that these conversations are happening at a higher level suggests that the groundwork is being laid. And in markets, anticipation is often just as powerful as confirmation. Smart money doesn't wait for the official announcement. It positions early before the narrative becomes obvious to everyone else. At the same time, you have to consider XRP's unique position compared to other cryptocurrencies. Unlike many projects that are driven primarily by speculation or decentralized applications, XRP has a very specific use case centered around cross-border payments and liquidity solutions. This is where Ripple has focused its efforts, building partnerships with financial institutions and payment providers around the world. That real-world utility is something institutional investors pay attention to, especially when they're evaluating long-term exposure rather than short-term trades. An ETF built around XRP wouldn't just represent a bet on price, it would represent a bet on the adoption of a global financial infrastructure layer. Another factor that cannot be ignored is how market psychology plays into all of this. The crypto market is heavily narrative-driven, and right now, the ETF narrative is one of the strongest catalysts you can have. Once the idea of an XRP ETF gains traction, it creates a feedback loop. Media coverage increases, social sentiment shifts, and retail investors start paying attention again. That increased attention then feeds back into price action, which attracts even more interest. It's a cycle that we've seen play out before, and it often accelerates much faster than people expect. However, it's important to stay grounded and analytical. An ETF is not a guaranteed outcome, and even if it does happen, it won't solve everything overnight. There are still regulatory hurdles, approval processes, and structural considerations that need to be addressed. But what matters right now is direction, and the direction is clearly shifting from uncertainty to possibility. That alone is enough to start changing how XRP is perceived in the broader financial landscape. What's particularly important to understand right now is how early-stage narratives typically behave in financial markets, especially when they involve institutional products like ETFs. The majority of investors tend to focus only on confirmed news, the official approval, the launch date, the headlines. But by the time those confirmations arrive, a significant portion of the move is often already priced in. This is where positioning becomes critical. The current phase surrounding XRP is not about reaction, it's about anticipation. And when you start seeing discussions around ETF structures, filing speculation, and institutional curiosity increasing, it usually indicates that the groundwork phase is already underway beneath the surface. Another layer to this is how institutions actually think about assets like XRP. Retail investors often view price in isolation. Will it go up or down? How fast and how high? But institutions evaluate liquidity, regulatory clarity, utility, and long-term integration into financial systems. XRP checks several of these boxes in a way that is fundamentally different from many other digital assets. Its role in cross-border transactions, on-demand liquidity, and its integration into payment corridors gives it a framework that aligns more closely with traditional financial infrastructure. That alignment is exactly the kind of narrative that makes an ETF product more viable because it's easier to present to institutional clients as part of a diversified portfolio strategy. At the same time, you have to look at how capital flows react when access becomes easier. When barriers to entry are reduced, participation increases. It's a simple but powerful dynamic. ETFs remove friction. They eliminate the need for managing wallets, dealing with exchanges, and navigating unfamiliar platforms. For a large segment of the financial world, that convenience is not optional. It's essential. If XRP becomes accessible through an ETF structure, it effectively opens the door for capital that would otherwise never touch crypto directly, and that's where the scale factor comes in. Even a small percentage allocation from large funds can translate into massive inflows relative to the current market size. There's also a strategic angle that many people overlook. Financial institutions are highly competitive, and once one major player moves into a new asset class or product category, others tend to follow. No firm wants to be the last to offer exposure to a high-performing or high-interest asset. This creates a domino effect. If momentum around XRP-based investment products continues to build, it could trigger a wave of interest from asset managers who want to secure their position early. This isn't driven by hype, it's driven by competition and the need to capture market share. Market structure also plays a critical role here, and XRP has historically shown the ability to move aggressively when liquidity conditions shift. If new demand enters the market through institutional channels while supply remains relatively constrained, price reactions can become amplified. This is especially true in crypto, where order books can be thinner compared to traditional markets. The introduction of ETF-driven demand doesn't just add buyers, it changes the entire balance between supply and demand. And when that balance shifts, it often does so rapidly. Another key factor is sentiment transition. For a long time, XRP has operated under a cloud of uncertainty, which kept a portion of the market on the sidelines. But as that uncertainty begins to fade, those sideline participants start to reconsider their positions. This creates a re-entry effect where previous skeptics or cautious investors begin to allocate capital again. Combined with new interest driven by ETF speculation, this can create overlapping waves of demand. And in financial markets, overlapping demand is where momentum truly accelerates. It's also worth paying attention to how narratives evolve over time. What starts as speculation often turns into expectation and eventually into confirmation. Each stage brings a different type of participant into the market. Early adopters move during speculation, strategic investors position during expectation, and the broader public enters during confirmation. Understanding which stage the market is currently in can provide a significant edge. Right now, XRP appears to be transitioning from speculation toward expectation, and that's a phase where volatility and opportunity tend to increase simultaneously. At this point, the focus should not be on short-term price predictions, but on structural shifts. The possibility of an ETF represents a structural change in how XRP can be accessed, perceived, and integrated into the financial system. These types of changes don't happen frequently, but when they do, they tend to redefine the trajectory of an asset over the long term. And that's why this development is being taken more seriously by those who understand how capital markets evolve. As the situation continues to develop, the key signals to watch will come from institutional behavior rather than social media noise. Movements behind the scenes, shifts in regulatory tone, and increasing discussion among financial firms will all provide clues about where this is heading, because in markets like this, the most important moves often happen quietly, right before they become impossible to ignore. One of the most critical elements that could drive this entire XRP ETF narrative forward is regulatory positioning, because at the end of the day, no institutional product reaches the market without passing through a very strict framework of compliance and approval. And this is where XRP's situation becomes particularly interesting compared to many other digital assets. Over the past few years, the legal clarity surrounding Ripple and its association with XRP has evolved in a way that has gradually reduced uncertainty. While the process has been long and complex, what matters to institutions is not perfection, it's clarity. Once an asset has a clear regulatory identity, it becomes significantly easier to build financial products around it. From an institutional perspective, risk is not just about volatility, and it's about unknowns. And historically, XRP carried a level of regulatory ambiguity due to its interactions with the U.S. Securities and Exchange Commission. That ambiguity acted as a barrier, preventing many firms from even considering exposure. But as the legal landscape has started to shift, The perception of XRP is changing from uncertain asset to emerging regulated opportunity. That transition is extremely powerful because it doesn't just attract attention. It unlocks participation from players who were previously restricted by compliance requirements. At the same time, there's a broader macro trend happening in financial markets that cannot be ignored. Traditional finance is no longer resisting digital assets in the same way it once did. Instead, it's actively looking for ways to integrate them into existing systems. This is being driven by client demand, competitive pressure, and the realization that blockchain-based assets are not going away. In that context, XRP holds a unique position because of its focus on efficiency, settlement speed, and cross-border liquidity. These are not abstract concepts, and they are real-world financial problems that institutions deal with every day. And when an asset aligns with real-world utility, it becomes much easier to justify as part of a structured investment product. Another important aspect is how ETF approval decisions are often influenced by precedent. When one digital asset successfully enters the ETF space, it creates a framework that can be applied to others. This is exactly what happened with Bitcoin, where the introduction of spot ETFs didn't just impact BTC itself, it opened the door for discussions around other cryptocurrencies. Regulators and financial institutions now have a reference point. They understand the custody models, the pricing mechanisms, the risk disclosures, and the investor demand. That familiarity reduces friction when evaluating new ETF proposals, including those potentially tied to XRP. Market infrastructure is another piece of the puzzle that's quietly strengthening in the background. Custodial services, compliance tools, and institutional-grade trading platforms have all improved significantly. These developments are essential because an ETF is not just a financial product, it's an ecosystem. It requires secure custody, reliable pricing feeds, liquidity providers, and regulatory oversight. The more mature this infrastructure becomes, the easier it is to support new ETF products. XRP is now operating in a market environment that is far more developed than it was just a few years ago, and that evolution increases the probability of more sophisticated financial instruments being introduced. There's also a psychological component that plays into regulatory progress. As more institutions begin to show interest in XRP, it creates a feedback loop that can influence regulatory attitudes. Increased institutional involvement often leads to more formal discussions, more detailed proposals, and more pressure to establish clear guidelines. Regulators don't operate in isolation. They respond to market developments, industry engagement, and economic incentives. If XRP continues to attract serious attention from financial players, it naturally becomes a higher priority within regulatory frameworks. Another factor that deserves attention is global positioning. While much of the focus tends to be on the United States, XRP's use case is inherently international. Cross-border payments, remittances, and liquidity solutions are global markets, and regulatory progress in one region can influence adoption in others. If ETF-related developments gain traction in key financial hubs, it could create a ripple effect that extends beyond a single jurisdiction. This global dimension adds another layer of potential growth because it expands the scope of where and how XRP can be integrated into financial systems. At this stage, the narrative is no longer just about whether XRP can survive regulatory scrutiny. It's about how it can evolve within a regulated environment. That shift in perspective is crucial. Survival is defensive, but integration is expansion. And ETFs represent one of the clearest paths toward integration with traditional finance. They act as a bridge, connecting digital assets with conventional investment structures in a way that is both familiar and scalable. As momentum continues to build, the focus should remain on tangible signals rather than speculation alone. Regulatory filings, institutional commentary, and shifts in compliance frameworks will all serve as indicators of progress. Because when it comes to developments like this, the biggest moves are not driven by hype. They're driven by structural alignment between markets, institutions, and regulation. And right now, XRP is moving closer to that alignment than it has at any point in its history. Another dimension that's starting to gain serious attention is the potential impact an XRP ETF could have on overall market liquidity and price discovery, because this is where things move beyond theory and into actual market mechanics. When a new financial instrument like an ETF is introduced, it doesn't just bring in new investors. It changes how the asset is traded, how it's priced, and how capital flows in and out of the market. For XRP, this could represent a fundamental shift in its trading environment, especially considering how liquidity is currently distributed across exchanges and regions. Right now, XRP trading is still heavily influenced by retail participation and crypto-native platforms. That creates a certain type of volatility where price movements can be sharp, sentiment-driven, and sometimes disconnected from underlying fundamentals. But when institutional capital enters through structured products like ETFs, the nature of that liquidity changes. Institutional flows tend to be larger, more strategic, and often longer-term in nature. This doesn't eliminate volatility, but it can reshape it, making price movements more reflective of macro trends and capital allocation decisions rather than purely speculative momentum. At the same time, ETFs introduce a new layer of demand that operates independently from traditional crypto market cycles. Instead of relying solely on retail enthusiasm or crypto-specific narratives, XRP would begin to attract capital from broader financial markets. This includes portfolio managers who are looking to diversify, hedge funds seeking asymmetric opportunities, and even passive investment strategies that allocate based on index inclusion or sector exposure. That diversification of demand sources is extremely important because it reduces reliance on any single type of investor and creates a more balanced market structure. There's also the concept of supply pressure, which becomes increasingly relevant as demand grows. XRP has a known supply structure, and while there is a large circulating supply, the availability of liquid XRP at any given time can vary significantly depending on market conditions. If ETF-related demand begins to absorb a meaningful portion of that liquidity, it can create upward pressure on price, especially during periods where selling activity is limited. This dynamic has been observed in other markets, where sustained inflows gradually tighten available supply and amplify price reactions over time. Another critical factor is arbitrage and price alignment across markets. ETFs rely on mechanisms that keep their price closely tied to the underlying asset, which involves authorized participants, market makers, and arbitrage strategies. If XRP were to have an ETF, these mechanisms would start to play a larger role in its ecosystem. This could lead to more efficient pricing across exchanges, reduced discrepancies between markets, and an overall increase in market maturity. In simple terms, XRP would begin to behave more like a traditional financial asset in terms of how its price is stabilized and managed across different platforms. Beyond the mechanics, there's also the narrative impact that cannot be ignored. Financial markets are heavily influenced by perception, and the existence of an ETF signals legitimacy. It tells the broader market that an asset has reached a level of acceptance where it can be packaged, regulated, and offered to mainstream investors. For XRP, which has spent years navigating skepticism and regulatory challenges, that shift in perception could be just as important as the capital inflows themselves. Legitimacy attracts attention, and attention attracts capital. It's a cycle that tends to reinforce itself once it begins. It's also worth considering how this development could reposition XRP within the broader crypto hierarchy. For a long time, the spotlight has been dominated by a few major assets, particularly Bitcoin and, to a growing extent, Ethereum. But the introduction of an XRP ETF would force a reevaluation. It would place XRP into the same category of institutional-grade assets, at least in terms of accessibility. That doesn't just impact investors. It impacts media coverage, analyst focus, and overall market attention. And in financial markets, attention is a powerful driver of momentum. There's also a strategic advantage in timing. The crypto market moves in cycles, and each cycle tends to be defined by a dominant narrative. In previous cycles, we've seen narratives around ICOs, DeFi, NFTs, and institutional adoption. The ETF narrative is shaping up to be one of the defining themes of the current cycle, and assets that align with that narrative early tend to capture a disproportionate share of the gains. XRP entering that conversation at this stage could position it as a key player in the next phase of market expansion. At this point, it becomes less about speculation and more about probability. The combination of improving regulatory clarity, growing institutional interest, evolving market infrastructure, and strong narrative alignment creates a scenario where the likelihood of an XRP ETF is no longer negligible. This entire XRP ETF narrative continues to build momentum. The most important shift happening right now is not just external, it's internal within the market itself. Investors are starting to reassess what XRP actually represents in a long-term portfolio. For years, it was often treated as a speculative asset tied closely to legal outcomes and short-term volatility. But now, the framing is beginning to change. XRP is increasingly being viewed through the lens of infrastructure, liquidity, and institutional relevance. And when an asset transitions into that category, the way capital interacts with it changes completely. What makes this moment particularly critical is the convergence of multiple catalysts at the same time. You have regulatory clarity improving, institutional awareness rising, infrastructure maturing, and now the ETF narrative acting as a potential trigger for large-scale capital inflows. Individually, each of these factors is significant, but together they create a compounding effect. This is how major market moves are formed, not from a single event, but from the alignment of several powerful trends all pointing in the same direction. At the same time, it's essential to maintain a realistic perspective. Markets don't move in straight lines, and even the strongest narratives go through phases of doubt, correction, and consolidation. If XRP does move closer toward an ETF reality, there will likely be periods of volatility, profit-taking, and shifting sentiment. That's a normal part of any market cycle. What separates experienced participants from the rest is their ability to focus on the bigger picture, rather than getting distracted by short-term noise. Another key element to consider is how quickly sentiment can shift once a narrative reaches a tipping point. Right now, the idea of an XRP ETF is still developing, still being debated, and still not fully priced in. But if a major signal appears, and whether it's a formal filing, institutional confirmation, or a regulatory shift, the reaction could be immediate and aggressive. Markets are forward-looking, and they tend to move ahead of confirmed reality. By the time something becomes obvious, the opportunity is often significantly reduced. There's also a broader implication here for the entire crypto market. If XRP successfully moves toward ETF integration, it reinforces the idea that digital assets are becoming a permanent part of the global financial system. It's not just about one asset anymore, it's about the validation of an entire asset class. And that kind of validation tends to attract even more capital, more innovation, and more institutional participation across the board. From a strategic standpoint, this is a phase where awareness matters more than reaction. Understanding what's developing, identifying the signals, and recognizing how market structure is evolving can provide a significant advantage. This isn't about chasing hype. It's about recognizing when a narrative is transitioning into a structural shift, and right now, XRP appears to be moving directly into that kind of transition zone. As always, it's important to approach this space with a balanced mindset. Opportunities exist, but so do risks. The information discussed here is based on current market trends, institutional behavior, and emerging narratives, all of which can change over time. Nothing in this video should be considered financial advice. Always do your own research, evaluate your risk tolerance, and make decisions based on your individual financial situation. The crypto market is highly volatile, and while the potential upside can be significant, it's equally important to be prepared for uncertainty.